Hey everybody, Eric Sandstrom, the Guideline Guru with Prime Lending. Let's chat about a topic that's become very popular and concerning with new home buyers, and that's mortgage insurance. Okay, so it might be a sensitive topic, but hopefully I'll be able to educate you guys as far as some options here. Okay, so what we're going to chat about is what is mortgage insurance, when is it required, when does it go away, and are there any options to eliminate or reduce it? And at the end of this, the video here, I'm going to bring up a screen and I'm going to teach you as a home buyer or future home buyer, or even if you're looking to refinance, how to calculate mortgage insurance, what it would be monthly, and what it would be as a single premium. We're going to chat about that single premium here in a second. Okay, so what is mortgage insurance? Mortgage insurance is to protect the lender in case you default. It has no benefit to you as the borrower, okay? It's just to protect us as the lender because you put less than 20% down. So that's the next thing that we were going to talk about is what is required. And it's usually when you put less than 20% down on a conventional loan, okay? If you're going jumbo or portfolio, sometimes that mortgage insurance is rolled in and you don't have an extra payment, but we're going to talk about alleviating that on a conforming loan here in a second, okay? The next step is when does it go away? So if you're somebody that has mortgage insurance right now and you want to find out when it goes away, well, you've got to typically have it for about 5 years. That's required. And after 5 years, you can reach out to the loan servicer and you can do one of two things. You can request that they order an appraisal on the property. And as long as that appraisal shows that you've got 20% equity or more, you can get that MI removed, typically, okay? You're going to have to look at your loan docs and make sure that's the case. The other option is as long as you've paid the loan down, let's say you've paid it off a little bit faster, but you paid the loan down to 78% of the appraised value at the time that you bought the home, you can also eliminate the MI, okay? But you usually would require that you pay more during that process. Now, so those are the options to eliminate or reduce the MI. So now that we've talked about that, let's talk about a couple different options when it comes to buying a house or refinancing when you can get rid of the MI or eliminate it. There's one option that I'm very I love a lot. It's called single premium MI. I did this on my house when I bought it. You want to take a look at what the option is or how much it costs to buy out the MI as a single premium, okay? So it's just a one lump sum payment and it gets rid of that monthly payment. So if you've got a monthly payment MI, you can get rid of it via single premium, but you've got to do it during the loan process. Okay, I'm gonna show a graph here soon. There is another option, and that is called lender paid mortgage insurance. Okay, so lender paid, what ends up happening is the lender ends up basically paying it for you, but it's through a higher interest rate usually. So what happens is when you boost that interest rate, it provides a credit that essentially pays for the single premium MI. Okay, so it's really not that full savings, but it's something. Something also just came out that has been about a week, maybe 2 weeks old, and it's only through one company that I'm going to be showing you here in a second. But you can buy out the mortgage insurance in a portion. So if you only have $1,000 to throw at it, and it's $5,000 to eliminate it, or let's say you've got $2 grand, $3 grand, $4 grand. It will tell you what your monthly payment will be reduced to if you buy it out in a portion, okay? So now that we've talked about MI, what is it? When is it required? When does it go away? Let's get to the fun stuff. Let's get to the graphs, and I'm going to show you how to calculate this yourself. And of course, please reach out to me if you have any questions. I am multi-state licensed, so I can do home loans basically everywhere, and I'd be happy to help you. Okay, so let's get to no ado, and let's bring up that screen. Thanks, guys. All right, so let's go ahead and take a look at pricing out the mortgage insurance. I ran into a little bit of a hiccup with the paying for the portion of the single premium. So please do call me if you want some quotes on if you are to pay, let's say, a portion of the single premium, and then want to see how that's going to affect your monthly payment. Just go ahead and let me know. Now let's obviously start off at the same screen here. Google. We're going to go to Google and we're going to type in Essent, ESSENT, rate finder. All right, Essent's a mortgage insurance provider. And then go ahead and click enter. When you're there, you're going to see this right here, Essent Rate Finder. Go ahead and click on that. And this is going to bring up a section of what information you need to put in. I'm going to make this larger for you guys, okay? Don't worry about the stuff at top. Keep this the same. Do you approve eligible, or if you're Freddie Mac would be LPA, but just go ahead and click DU. So for the base loan amount for this one, let's just do for this case, we'll do $500,000. We're going to do a fixed 30-year conventional loan, and we're going to say this guy has a debt-to-income ratio of 30%. Okay, so that's DTI 30%. Okay, it's not an affordable housing loan, so we're just going to leave that alone. And for the zip code, go ahead and enter the zip code. I'll enter mine, 91977. And then for the loan to value, let's go ahead and put 5%. So let's say this, or 95%, which is 5% down. So let's say this person is putting 5% down. Let's say we've got two borrowers on this loan. We've got one with the 740 credit, and we have one with the 760. Okay. The more borrowers that you have on the loan, actually the MI premium does get reduced. Because it is less risky, so that's the reasoning for that. The coverage amount, don't change that. That should already be in there, ready to go, populated based off of the amount that you're putting down. Okay. And this is going to be the monthly. There's deferred monthly. There's single. You want to focus on these two right here, deferred monthly and single. And then there's also lender paid here, but we're going to, again, focus on deferred monthly. Okay, so interest rate doesn't matter. Let's say this person is getting a 4.75. Just go ahead and put that in there, but it shouldn't matter with the MI rate quote. Then let's go ahead and click Get Quote right here. Get Quote. It's saying I did something wrong, so let's go ahead and go up. Saying enter in your corporate email address, so I'll just enter in my personal address here. That should be fine. Get quote. Yep. Okay, so this is the borrower paid. So this is, again, if you're looking at getting the monthly premium. Monthly premium is $175. Okay, so let's remember that $175, pretty easy to remember. So this would be the monthly MI premium, 175 bucks. Okay, mainly because this guy, let's say this borrower has great credit. All right, so we've determined the monthly amount. So this is required to have for, let's say, 5 years. So let's bring up the calculator. Let's say 175 times 5 years is 60 months. So you're basically paying $10,500 guaranteed unless you refinance by paying this $175 a month. Okay. Now let's take a look at single premium. Single premium borrower paid. So this is if you're paying it. And then we're going to say the full premium. Okay, so we're going to do the full premium, and let's see what this gives us. So again, single premium changed here. Borrower paid. Interest rate doesn't matter. Full premium here. Get quote. All right, so what it's telling us is this upfront premium is going to cost $7,950. So $7,950 of course, is less than 10,500. So with that factor, let's calculate the cost for recovery period. Okay, so let's say the single premium buyout is $79.50, and then the monthly. So we're going to divide it by the monthly, which is $175. That's 45 months. Divide that by 12. That's 3.78 years before you recover from paying that mortgage insurance in full. Okay, so if you're going to refinance before that time, you're going to sell before that time, then of course it would be more beneficial to go with the monthly. But if you're going to go with the single premium, keep this loan for a long period of time, interest rates, we don't know if they're going to go up or go down, then obviously it can be more beneficial to take the single premium route and then just get your monthly payment as affordable as possible. Okay, so that's the single premium. Let's see if we can do lender paid real quick. And we're going to say lender paid rate. We'll just say, again, 4.75. I'm just curious what it'll do. So lender paid, it's basically saying how much this lender, or us rather, need to come up with in regards to credits to buy out the single premium. So that's lender paid. We'd have to figure out what we'd have to bump the interest rate up to in order to cover the cost of this, which in most cases it's going to be significant. Now, if you're looking for the tax benefit, obviously you can write off more interest on the loan. When mortgage insurance, I can't confirm whether it is or is not tax deductible. I am not a CPA. So please discuss that with your CPA. So that's the gist of it for the single premium versus the borrower paid monthly. Hopefully you guys learned something. Again, I priced this one out through Ascent Rate Finder, and that gave me information on what it's going to be monthly and as a single premium as well. Okay, please give me a call if you have any questions, concerns, or want to go over the scenario yourself. I'd be happy to go over it with you. Thanks a bunch. Eric Sandstrom, the Guideline Guru.